The cycle of repeated losses is one of the most frustrating and misunderstood experiences in trading. Many traders enter the market with strong motivation, a willingness to learn, and the belief that consistent effort will naturally lead to consistent profits. In the beginning, there is often excitement and optimism. Every new strategy feels like the one that will finally work, every chart pattern seems full of opportunity, and every trade carries the hope of success. However, as time passes, this initial confidence often begins to fade. Despite putting in hours of study, testing different approaches, and trying to stay disciplined, the results remain inconsistent. Wins may come occasionally, but they are often followed by losses that erase progress, creating a sense of going in circles rather than moving forward. One of the biggest reasons traders remain stuck in this cycle is the illusion of progress. When something is not working, the natural reaction is to change the strategy. A trader might move from one indicator to another, from scalping to swing trading, or from technical analysis to price action. Each new approach brings a fresh sense of hope and temporary confidence. Learning something new feels like improvement, and sometimes there are short-term wins that reinforce the belief that progress is being made. However, these wins can be misleading. They often mask deeper issues that are not related to the strategy itself. As a result, even though the surface-level approach keeps changing, the underlying problems remain the same, eventually leading to the same disappointing outcomes. This leads to a repetition pattern that many traders fail to recognize. Mistakes do not always appear in obvious or identical forms. Instead, they evolve and disguise themselves within different strategies and market conditions. A trader who struggles with entering too early might do so, whether they are using indicators or pure price action. Someone who exits trades emotionally may repeat that behavior regardless of the time frame they trade. Losses begin to feel random, as if they are caused by unpredictable market movements, but in reality, they often follow consistent behavioral patterns. The same types of decisions, driven by the same habits and emotions, keep producing the same results. The strategy changes, the charts look different, but the outcome remains surprisingly similar. Another major factor that keeps this cycle alive is the tendency to focus on external causes rather than internal ones. It is very common for traders to blame the market when things go wrong. Volatility, sudden reversals, news events, or even so-called market manipulation become easy explanations for losses. While these factors do play a role in trading, relying on them as the primary explanation prevents real growth. When everything is attributed to external conditions, there is no reason to look inward. The trader begins to believe that success is out of their control, dependent entirely on market behavior, rather than their own decisions. This mindset creates a dangerous loop where responsibility is avoided and improvement becomes almost impossible. In contrast, experienced traders eventually realize that the market is not the true problem. Instead, the key lies in understanding personal decision-making patterns. Every trade involves choices: when to enter, when to exit, how much risk to take, and whether to follow a plan or act on impulse. These decisions are influenced by emotions such as fear, greed, impatience, and overconfidence. Without recognizing and addressing these internal factors, no strategy can produce consistent results. A trader may have a profitable system on paper, but if they cannot execute it with discipline, the outcome will still be negative. The most important insight in breaking this cycle is understanding that losses are rarely random. When losses repeat over time, it is usually a sign of an underlying issue that has not been identified or corrected. This realization can be uncomfortable, as it shifts the focus from external excuses to personal responsibility. However, it is also the turning point. Once a trader accepts that the problem may lie in their behavior rather than the market, they gain the ability to change it. Patterns can be analyzed, mistakes can be tracked, and habits can be improved. Ultimately, progress in trading does not come from constantly searching for the perfect strategy. It comes from developing self-awareness, discipline, and consistency in decision-making. The cycle of repeated losses begins to break when a trader stops looking for quick fixes and starts focusing on understanding their own actions. This shift transforms trading from a frustrating guessing game into a structured process of growth. While losses may still occur, they no longer feel random or uncontrollable. Instead, they become valuable feedback, guiding the trader toward long-term improvement and stability. The core misunderstanding in trading is rarely about lacking knowledge or not having the right strategy. It is much deeper than that. Many traders believe that success comes from mastering indicators, finding the perfect entry, or predicting the market accurately. While these elements have their place, they are not the true reason why most traders struggle. The real issue lies in how risk, probability, activity, and emotions are misunderstood and handled. These misunderstandings quietly shape decisions, often leading traders into patterns that consistently produce poor results, even when they appear to be doing everything right. One of the most common mistakes is misinterpreting risk. Traders often focus heavily on potential reward while treating risk as a secondary concern. The idea of making large profits becomes the primary motivation, and as a result, risk management is either ignored or applied inconsistently. Position sizing, which is one of the most critical aspects of trading, is frequently overlooked. Instead of maintaining a fixed and controlled level of exposure, traders may increase their position size after a loss to recover quickly or after a win due to overconfidence. This creates an unstable foundation where outcomes become highly unpredictable. Even a good strategy can fail if risk is not controlled properly, because a few large losses can wipe out many small gains. Another major misunderstanding involves probability. Trading is a game of probabilities, not certainties, yet many traders approach it with the expectation that individual trades should succeed. This mindset creates unnecessary pressure on every trade, making losses feel like failures rather than a natural part of the process. As a result, traders often struggle to accept losing trades. They may hold on to losing positions for too long, hoping the market will reverse, or close winning trades too early out of fear of losing profit. Over time, this behavior disrupts the natural balance required for a profitable trading system. Additionally, overconfidence in one's ability to predict the market further complicates the issue. When traders believe they can consistently forecast outcomes, they become less disciplined and more prone to taking unnecessary risks. A related issue is the confusion between activity and productivity. Many traders believe that being more active in the market will lead to better results. This belief encourages overtrading, where traders take excessive positions in search of more opportunities. At first glance, this may seem logical. More trades should mean more chances to win. However, in reality, it often leads to the opposite. As the number of trades increases, the quality of those trades tends to decrease. Traders begin to enter positions without proper confirmation, driven by the need to stay engaged rather than by a well-defined plan. This constant activity not only reduces profitability, but also increases transaction costs and emotional stress. True productivity in trading is not about how often you trade, but about how well you execute high-quality setups. Emotions play a powerful role in reinforcing these misunderstandings. Fear, greed, and frustration are constant influences that shape decision-making, often without the trader fully realizing it. Fear can cause hesitation, leading to missed opportunities or early exits from trades that might have been profitable. Greed, on the other hand, can push traders to take on excessive risk, hold on to trades longer than they should, or abandon their strategy in pursuit of bigger gains. Frustration, especially after a series of losses, can lead to impulsive decisions. Revenge trading, abandoning rules, or entering trades without proper analysis. These emotional reactions create inconsistency, which is one of the biggest obstacles to long-term success in trading. The key lesson in all of this is that the core misunderstanding is not always technical. It is often behavioral and psychological. A trader can have access to the best tools, the most advanced strategies, and endless educational resources, yet still fail if they do not understand their own behavior. The way risk is managed, the way probabilities are interpreted, the level of discipline in trading activity, and the ability to control emotions all play a far greater role than most people initially realize. Correcting this misunderstanding leads to a fundamental shift in decision-making. Instead of focusing on being right, traders begin to focus on managing risk and executing consistently. Losses are no longer seen as personal failures, but as expected outcomes within a probabilistic system. Trading activity becomes more selective and intentional, with an emphasis on quality over quantity. Most importantly, emotional awareness improves, allowing traders to recognize and control impulsive behavior before it impacts their decisions. This shift does not happen overnight, but once it begins, it changes everything. Trading becomes less about chasing outcomes and more about following a structured process. With time, consistency replaces chaos, and the cycle of repeated mistakes starts to break. The trader moves from reacting emotionally to acting with purpose, and that is where real progress begins. The misunderstanding at the core of trading does not stay isolated as a theory. It directly influences every single trade a person takes. From the moment a trader analyzes the market to the point where they exit a position, their decisions are shaped by how well they understand risk, probability, and their own behavior. When these elements are misunderstood, the impact becomes visible in subtle but consistent ways. Over time, these small decision-making errors accumulate, creating a pattern of inconsistency that prevents long-term success. One of the first areas where this misunderstanding shows up is in entry decisions. Instead of waiting for clear confirmation based on a defined trading plan, many traders enter trades prematurely. There is often a fear of missing out on a move, which leads to chasing price rather than letting the market come to them. A setup may be incomplete, conditions may not fully align, yet the trade is taken anyway. This behavior is usually driven by impulse rather than structure. The trader feels the need to be involved, to catch the move early, or to avoid regret. However, entering without confirmation reduces the probability of success from the very beginning. Even a strong strategy becomes ineffective if it is not executed with patience and precision. The same misunderstanding continues into risk management, where its effects become even more damaging. Traders often start with a plan, including a defined stop-loss, but fail to follow it when the trade moves against them. Instead of accepting a controlled loss, they move the stop-loss further away, hoping the market will reverse. This decision is rarely logical. It is emotional, driven by the desire to avoid being wrong. In other cases, traders increase their risk after a loss, attempting to recover quickly. This behavior, often referred to as revenge trading, can quickly escalate losses and destabilize the account. Ignoring predefined limits creates an environment where risk is no longer controlled, turning trading into a high-stakes gamble rather than a calculated process. Exit decisions are another area heavily affected by this misunderstanding. Many traders struggle to exit trades correctly, not because they lack knowledge, but because emotions take control. Fear often leads to closing trades too early. A position that is moving in profit may be exited prematurely because the trader is afraid of losing those gains. On the other hand, losing trades are often held for too long. Instead of accepting a small, planned loss, the trader waits, hoping the market will turn in their favor. This creates an imbalance where losses become larger than intended, while profits remain smaller than they could be. Over time, this imbalance alone can make it nearly impossible to achieve consistent profitability. Overtrading is another direct consequence of these underlying issues. When traders confuse activity with productivity, they begin to take more trades than necessary. Every market movement feels like an opportunity that must be acted upon. Instead of waiting for high-quality setups, they react to minor fluctuations, entering trades without clear reasoning. This not only reduces the quality of decisions, but also increases exposure unnecessarily. More trades mean more opportunities for emotional mistakes, more transaction costs, and more mental fatigue. The trader becomes trapped in a cycle of constant action, leaving little room for reflection or improvement. The long-term impact of these behaviors is significant and often underestimated. Each individual mistake may seem small: a slightly early entry, a minor adjustment to a stop-loss, an emotional exit, but together they create a pattern of inconsistency. This inconsistency leads to unpredictable results, making it difficult to identify what is working and what is not. As losses accumulate or profits fail to grow steadily, account performance begins to decline. More importantly, confidence in the trading process starts to erode. The trader may begin to doubt their strategy, their skills, or even their ability to succeed in trading at all. This loss of confidence can be more damaging than the financial losses themselves. When a trader no longer trusts their process, they are more likely to abandon it, switch strategies again, or act even more impulsively. The cycle then repeats, often with increased frustration and confusion. What started as a misunderstanding of key principles turns into a deeply ingrained pattern of behavior that affects every aspect of trading. Understanding how these issues influence each trade is a crucial step toward breaking the cycle. It shifts the focus from blaming outcomes to analyzing decisions. Instead of asking, did this trade win or lose? The more important question becomes, was this trade executed correctly? This change in perspective allows traders to identify patterns in their behavior and make meaningful adjustments. Ultimately, trading success is not determined by a single decision but by the consistency of many decisions over time. When misunderstandings are corrected, entries become more precise, risk is managed with discipline, exits are based on logic rather than emotion, and trading activity becomes more intentional. As a result, the overall process becomes more stable, and confidence begins to rebuild. This is how a trader moves from a cycle of repeated mistakes to a path of steady improvement and long-term growth. Developing the correct understanding in trading is not about discovering something new. It is about replacing deeply ingrained misconceptions with principles that align with how markets actually work. This shift is subtle but powerful. It transforms trading from a reactive, emotionally driven activity into a structured, disciplined process. The change does not happen instantly, but once it begins, it starts influencing every decision in a more stable and predictable way. The foundation of this transformation begins with accepting uncertainty. Many traders struggle because they subconsciously seek certainty in an environment that simply does not offer it. No matter how strong a setup looks, no trade is ever guaranteed. Once this reality is fully accepted, the need to predict the market begins to fade. Instead of trying to be right on every trade, the focus shifts to thinking in probabilities. Each trade becomes just one event in a larger series of outcomes. This perspective reduces emotional pressure, because a single loss no longer feels like failure. It is simply part of the process. By embracing uncertainty, traders become more patient, less reactive, and more aligned with the true nature of the market. With this mindset in place, risk management naturally becomes the top priority. Instead of asking, how much can I make from this trade? The question changes to, how much am I willing to risk? This simple shift has a profound impact. Defining risk before entering a trade ensures that every position is taken with intention and control. Consistent position sizing becomes essential, as it keeps exposure stable regardless of recent wins or losses. Protecting capital becomes the primary objective, rather than chasing profits. This approach may feel conservative at first, but it creates the stability needed for long-term growth. Traders who prioritize risk understand that survival in the market is the first step towards success. Another critical element is shifting to process-oriented thinking. Many traders measure success purely based on profit and loss, which creates an emotional roller coaster. A winning trade feels like validation, while a losing trade feels like failure. However, this perspective is misleading. A trade can be profitable even if it was executed poorly, and it can result in a loss even if it was executed perfectly. True progress comes from focusing on the quality of execution rather than the outcome. When traders begin to measure success by how well they follow their rules, consistency starts to improve. Emotions become less influential because decisions are no longer tied to immediate results. Over time, this approach builds confidence, not in individual trades, but in the overall process. To support this mindset, traders must build structured decision systems. This means having clear, predefined criteria for entering and exiting trades. There should be no ambiguity about what qualifies as a valid setup or when a trade should be closed. When rules are clearly defined, decision-making becomes simpler and more objective. It reduces the likelihood of acting on impulse or emotion, because the trader is no longer relying on feelings in the moment. Instead, they are following a system that has been planned in advance. Consistency in applying these rules is key. Even the best system will fail if it is not followed with discipline. Structure creates clarity, and clarity reduces hesitation and confusion. Finally, developing discipline over time is what ties everything together. Discipline is not something that appears overnight. It is built through repetition and self-awareness. Every time a trader follows their plan, even when it is difficult, they reinforce a positive habit. Every time they learn from a mistake without reacting emotionally, they strengthen their ability to remain objective. This gradual improvement is what leads to consistency. There will still be challenges, and mistakes will still happen, but the difference is in how they are handled. Instead of triggering frustration or impulsive behavior, mistakes become opportunities for learning and refinement. Over time, these changes begin to compound. Accepting uncertainty reduces emotional pressure. Strong risk management protects capital. Process-oriented thinking creates consistency. Structured systems guide decisions, and discipline ensures everything is executed properly. Together, they form a solid foundation that supports long-term success in trading. Ultimately, developing the correct understanding is about shifting from control to management, from trying to control the market to managing one's own behavior within it. When this shift happens, trading becomes less about chasing outcomes and more about executing a well-defined process. And it is within that process that consistency, confidence, and sustainable growth are built. Breaking the cycle of repeated losses and achieving stability in trading is not about working harder. It is about working differently. Many traders put in significant time and effort, yet remain stuck because they are focused on the wrong areas. Real progress begins when attention shifts inward, toward understanding personal behavior, building structured routines, and managing emotional responses. Stability is not created by eliminating losses, but by developing consistency in how decisions are made and executed over time. The first step in this process is identifying personal weaknesses. This requires honest and objective self-review, which can often be uncomfortable but is absolutely necessary. By analyzing past trades without emotional bias, traders can begin to see patterns that were previously overlooked. These patterns often reveal recurring mistakes: entering too early, exiting too late, increasing risk impulsively, or ignoring rules under pressure. Alongside this, recognizing emotional triggers is crucial. Certain situations, such as consecutive losses or missed opportunities, can lead to frustration, fear, or overconfidence. These emotions influence decisions in subtle ways, often without immediate awareness. By identifying both behavioral patterns and emotional triggers, traders gain clarity about what is truly holding them back. Once this awareness is developed, the next step is creating a sustainable trading routine. Consistency in behavior comes from consistency in structure. A well-defined routine begins before the market even opens. Pre-market preparation allows traders to analyze conditions, identify potential setups, and mentally prepare for the session ahead. This reduces the likelihood of impulsive decisions later. During trading, execution should follow a structured approach based on predefined rules. There should be no guesswork. Every trade should align with a clear plan. After the trading session, post-trade analysis becomes essential. Reviewing trades, documenting decisions, and maintaining a journal helps reinforce learning and track progress over time. This daily cycle of preparation, execution, and reflection creates a stable framework that supports disciplined behavior. Another key element in breaking the cycle is reducing emotional impact. Emotions cannot be completely removed from trading, but they can be managed. Accepting losses as a natural part of the process is one of the most important steps. When losses are expected rather than resisted, they lose their emotional intensity. Similarly, it is important to avoid overreacting to wins. A profitable trade does not necessarily mean a good decision was made, just as a losing trade does not always indicate a mistake. Maintaining emotional balance means staying neutral regardless of outcomes. This neutrality allows traders to think clearly and act according to their plan, rather than reacting to short-term results. Measuring long-term performance is another critical shift in perspective. Many traders focus too heavily on individual trades, judging success or failure based on immediate outcomes. However, trading performance can only be accurately evaluated over a series of trades. By looking at results over weeks or months, patterns begin to emerge that provide meaningful insight. Tracking consistency, such as how often rules are followed or how well risk is managed, is far more valuable than focusing on single wins or losses. This long-term view reduces pressure and encourages steady improvement. Progress in trading is gradual, and recognizing small improvements over time helps build confidence in the process. The final perspective ties everything together. Persistent losses are often not a result of a lack of effort, but a lack of correct understanding. Many traders work hard, study extensively, and try multiple strategies, yet fail to see results because their approach is built on flawed assumptions. Once these misunderstandings are corrected, decision-making begins to change. Trades are no longer driven by impulse or emotion, but by structure and discipline. Risk is managed consistently, and outcomes are viewed within the context of probability rather than certainty. As behavior becomes more consistent, results begin to reflect that consistency. The randomness and frustration that once defined trading start to fade, replaced by a sense of control and clarity. Stability is achieved not by avoiding losses, but by ensuring that both wins and losses occur within a well-managed system. Over time, this leads to steady performance, renewed confidence, and a deeper understanding of the trading process. In the end, breaking the cycle is not about finding a shortcut. It is about building a foundation. With the right understanding, disciplined execution, and a focus on long-term growth, trading transforms from a cycle of struggle into a structured path toward consistency and stability.